Welcome everyone to Chapter 6 of Financial Accounting. We'll be covering cost methods for inventory this week. And also the importance of control over inventory. So these are our learning objectives this week. We're going to be mainly learning about the different cost flow assumptions for inventory. And that's basically when we have identical units of inventory, how do we determine exactly what cost to assign to each sale? And we use the specific identification method, LIFO, FIFO, weighted average cost. And so those are the four methods of valuing inventory and also cost of goods sold. And, last chapter we covered retail inventory cycle as a whole, but the cost of the inventory sold was always given to us. Now we'll learn how to calculate it ourselves. And we'll go through a whole bunch of examples on how to do that. Also go over reporting inventory in the financials and some efficiency metrics like days sales and inventory, which is how fast is our inventory being sold after we get it. As far as the controls over inventory, there's the physical controls for the business, safeguarding it from damage or theft. And then there's the reporting controls, which as accountants, I think we focus a lot more on the reporting controls than the physical controls. And, there's a number of ways that we go through this. Physical control of the inventory is just making sure it's not stolen, not damaged. Access controls to the building are in place, so people can't just go and take it. Maybe if there's valuable items like at Walmart, they got little trackers on them, little locks to make sure that you can't take it. But also there's a lot of documents involved with this as well, just to keep track of what inventory that we have as a business and also the cost of it, who's approved getting it, who's approved selling it, that kind of thing. And also just to control, controls is how internal controls in general is how management runs the operations of the business and has traction, has control over what happens. That things don't just devolve into chaos, it creates order. And so purchase order authorizes purchase of inventory from a vendor. So we get the purchase, then a receiving report or a receiving document is the evidence that the inventory has been received. And then the vendor's invoice is evidence for the accounts payable and the cost of what the inventory cost. And this all controls and documents. So a receiving manager or a purchasing manager can look at all the documents and there's an audit trail. And you know exactly what was ordered and you can match what was ordered to what was received and then what was billed. And right, that in the ideal world, it's all the same, right? You order inventory from a vendor, you receive it, and then you get billed and then you pay it. That's the cycle for receiving inventory, and it all has to work correctly so that the business isn't getting ripped off. And then there's also a subsidiary inventory ledger that has a listing of all the on-hand inventory for a specific location. And, in a perpetual inventory system that's updated with all the receipts and all the sales. And so you know exactly what you should have on hand. And that, first of all, for the management of the business, management has control and knows if they need to order more inventory or if they need to order less inventory, because you don't want to have too much inventory on hand. There's warehousing costs, there's the cost to purchase it, and you don't actually get any money for it until you sell it, right? So that's efficiently, you want to hold the inventory on hand as less time as possible, and also have enough inventory on hand to supply your customers. And so having a subsidiary ledger of the specific items on hand, super important for management to know and manage their inventory. And then also for when doing an inventory count, it's also important for safeguarding inventory because in order to know if inventory was damaged or stolen or lost, you have to know what should be there and it has to be accurate. So then that brings us to physical inventory counts. And that's me doing a physical inventory count of grain. You actually have to climb on top of I had to climb on top like 150, 300 feet and then measure with a tape measure how tall is the pile of grain. And then you do like area of a cylinder, and the USDA has these density factors to determine how much grain is in a cubic foot, like how many bushels of grain is in a cubic foot of silo. And it's really cool. And then you figure out, okay, there's like 5 million bushels at this plant. And then how many bushels should be there? Is it accurate? And like I was doing this for an audit to make sure that the inventory that they had was actually there. But um, it's important, right? It's important to have controls over inventory because I've also been to inventory counts. Maybe grain isn't a very good example, but like chemicals. And there's all sorts of different types of chemicals. They're all in these little containers, and you're supposed to have like 5 of this, 100 of this, 200 of this other one. And if the receiving and shipping orders are not kept track of and not entered into the system correctly, counting inventory is an absolute nightmare because nothing is where it should be. It's not the same on the listing and on the floor, like of what's actually there. And then you don't know how much you have as a business. You don't like, how are you supposed to operate a retail business if you don't know how much inventory you have? So that's why all of this is super important. And that kind of sets the stage for the rest of what we'll talk about today is how to actually calculate what our cost of goods sold is based on the purchases and sales that we've made, during the month. So inventory cost flow assumptions help us determine what cost to assign to a particular item of inventory. And especially in, prices change all the time. And you're constantly purchasing inventory at different prices. So we have different methods for accounting for that price change because say we shoe company for like Foot Locker purchasing shoes and the prices go up because there's inflation. And some of the shoes cost $40, some of them cost $50, some of them cost $60. First in, first out means that the goods that were purchased first, that's what goes into cost of goods sold. Last in, first out means that the most recent shoes purchased is what makes it into cost of goods sold. And then weighted average cost means every time there's a purchase, the average cost of the inventory is computed. And then every single time there's a sale, that average over everything is what's used to determine the cost of the inventory. For example, we have a business that has a purchase, and this is as simple as it gets example. Only one unit was purchased every time, one for 9, one for 13, one for 14. So the total cost is $36, which is an average of 12 per unit. And the cost of goods sold and the gross profit is going to be different under each of these methods because of this. Because the first unit that was purchased was the cheapest one. It was only $9. And so if we're selling one unit for $20 each in each way, right, the method of inventory doesn't actually change the reality. This is only for how we are calculating what the cost of goods sold should be. So first in, first out, the first unit that was purchased is going to be our cost of goods sold of $9, which means the gross profit is going to be $11, and then the ending inventory is going to be $27. And 27 is the final two, the 13 and 14. That's what's left in ending inventory. And then last in, first out, or LIFO, the last unit that was purchased, which was the $13 unit, was that actually should be, oh, oh, this is this is LIFO throughout the period. So the first unit that was sold, yeah, this one doesn't make sense here, but this would be LIFO, this would be FIFO, and then this would be, the ending inventory is really the only thing on this slide that doesn't make any sense. But right, this would be for the first unit that's sold, $9. Second unit that's sold, if this was under FIFO, the second unit that's sold is the $13 unit because it's first in, first out. So you go down the list and then, right, so first sale, $9, second sale, $13, third sale, $14. That would be under first in, first out. Last in, first out, assuming that all the sales were made at the end of the month, it would go in reverse order and you would choose the inventory that was purchased last, and that would be assigned to your cost of goods sold. And there's different use cases for each of these examples, like why would a business choose a particular cost flow method? Generally, it's a combination of the nature of the business and the industry, and also what's allowed under tax law. So for specific identification cost flow method, think of this as a used car lot. Every single car is unique in a used car lot. Every single car has a VIN number, and they purchase them all for different amounts. So it makes sense to use specific identification for that kind of thing because we know what each unit of inventory costs. They're not unique. First in, first out, the oldest units that are sold are what's used. You assume that the oldest units in inventory are sold and the newest purchases are what's in ending inventory. A lot of times this is in something that's perishable or something that goes out of style. So clothing companies, a lot of times will use first in, first out because they're always getting rid of last season's merchandise, or produce companies, right? What's in ending inventory is assumed to be what's most recently purchased. So it makes sense to have the most recent purchases on the balance sheet and use the oldest purchases as the cost of goods sold. Last in, first out assumes the ending inventory is made up of the first purchases. And generally, this is the one that's chosen for tax purposes if it's allowed, or generally kind of accepted in an industry. And a lot of times this is done too in things where it doesn't matter what the first or the last inventory is. It's indistinguishable. Like think of an oil company. Almost all oil companies use last in, first out inventory method, and that's because it all just goes into these huge vats of oil. It's impossible to really determine, except for on paper, what units were sold first and last. It's fairly irrelevant, and generally in rising, prices rise, and especially oil prices, but also chemical prices, whatever else you could fit in a large bulk commodity. And being able to deduct those most recent purchases, like oil companies are constantly purchasing and selling oil, they want to be able to deduct the higher cost of goods sold because the most recent purchases were higher because of inflation. They want to be able to deduct that. So they use LIFO generally. Um, and then weighted average cost is the average cost over the past, and uh, generally that's used for ease of calculation. It's easier for an inventory system to calculate that, and it's also used when it really doesn't matter. Again, like the inventory is not perishable. So a common example of that is like chemical companies, where the costs aren't changing substantially, and it's just easier to compute weighted average cost. In homework problems, it can be more difficult to compute weighted average cost because there's a lot of multiplication of each, tranche of inventory and then division over the total units that were available for sale. But in practice, weighted average cost can be a simpler method for commodity inventory. Does anyone have questions about the definitions here? Great. So this is a really good example of the different method. This is of the different methods of inventory calculation. So FIFO, the first unit was $9. That means the gross profit's 11 and the inventory is 27. LIFO method, our gross profit is less because the last inventory unit, the $14 unit, was what was used as cost of goods sold. And so our ending inventory is lower than it would have been because it's using the old units that cost less. And then weighted average cost is in the middle because it uses the average cost of the units was $12. And we computed that by adding them all up and then dividing by the total amount of inventory available for sale, which was 3. And then ending inventory is $24. So cost of goods sold, 12, ending inventory, $12 per unit. There's 2 units, so it's 24. And we'll go over some of more calculations here. So for the purposes of illustration, we have an inventory subledger here of item 127B. And that really does bring back flashbacks of all my inventory counts and all these, it's impressive how you'll bring up inventory item 127B and everybody at the warehouse knows exactly what you're talking about. And it's, yeah. So we have our beginning inventory, 1,000 units at $20 a unit, and then an initial sale at $700, then a purchase of 500, sale, purchase. And at every point in time here, for example, the sale on the 4th, and this is the perpetual inventory method, so everything is recorded as we go. On the 4th, we only have access to the $20 inventory. So it's going to be the same for every method. And then as we go further here, we will have to compute, right? The sale on the 22nd, we now have 2 buckets of cost. We have one cost, $22.40, and another $20. And so we'd have to go through, and we'll go through more. This isn't meant to be an illustrative example. This is what the inventory subledger is like. And the homework will have a listing like this, and it'll say calculate what the journal entry should be for the sale on the 4th and the sale on the 22nd and the 28th and that kind of thing. And then value the ending inventory. The first in, first out method most accurately does describe the physical flow of goods most of the time, unless it's like oil, then it doesn't matter. So for retail, you sell what you got first. So that first in, first out is generally more accurate, but Other than specific identification, of course, if you can know exactly what item you sold, then that most accurately matches the cost to the sale. So here's our example under the FIFO method. So we have our initial quantity of 1,000 in inventory at $20 a unit. Then we sell 700 units of inventory, and the cost is $20 a unit because this is first in, first out, but also we only have the $20 inventory on hand on the 4th. Then we purchase another $500 in inventory at $22.40. And so now in the quantity section, see, we have two separate buckets or tranches of inventory. One is 300 units of the $20 inventory, and we have 500 units of the $22.40 inventory. And so the total cost would be added between the two, the 6,000 plus the 11,200. Then we sell, on the 22nd, we sell 360 units of inventory. And so first we use up the oldest inventory. So we have 300 times 20, and then we have 60 times 2240, and that computes our total cost of goods sold of $7,344. And then our ending inventory, all we have left is 440 in the 2240 bucket because we used up the 300. And then, another sale only of the 2240 inventory. And then a purchase at the end of 600 at $23.30. And then our ending inventory is our 200 of the 2240 inventory that's left, 600 of the $23.30 inventory that's left, and then we come out to our cost of goods sold. And so this is, and the sales portion of the sale entry is not affected by the inventory cost flow method because the sale is, it's the same either way. This is just to calculate the cost of goods sold for the journal entry, and then by extension, the ending inventory value that we assign. And this is the balance of the ending inventory. Once again, we have 200 of the January 10th inventory and then 600 of the January 30th inventory left. And the LIFO method is last in, first out. It was initially used in rare cases where the inventory most recently purchased is the most inventory that's most recently sold. Maybe most of the ending inventory balance is in some warehouse like way far away as a reserve, and all the recent shipments just go directly to the store, right? And all the ending inventory is actually in some warehouse far away, and was purchased years ago. That would be a rare case, but it could happen, and that would accurately reflect the actual flow of the inventory. However, LIFO is now used mostly for tax purposes, so companies can take a deduction now for the higher costing inventory, generally due to inflation. And because of this, a lot of companies will report it. Ideally, companies want to report high income to investors, low income to the IRS. In this particular case with LIFO inventory method, the IRS is like, no, if you are recording LIFO to the IRS, you have to report LIFO to your investors. And so that's why oil companies will report LIFO on their financial statements as well, which is why it's so important that we learn how to do it. And not just oil companies, by the way. Lots of companies do this. Oil companies is just the biggest example because they all do it that way. And it is determined based on the industry for the most part. And also, a lot of times when the LIFO inventory method is used, the subsidiary ledger is only in units. For example, they'll just record barrels of oil, and then the bean counters, the accountants at the end of the year, just sort of go back and do all the math and record the dollars just for the financials and the tax documents. It's a big calculation at the end of the year. And I can say I'm a bean counter because I've counted beans, millions of beans. So it's fun. For LIFO, the initial sale is the same, right? So we have our $20 inventory on the first, then on the fourth, we sell 300, we sell 700, 300 is remaining. It's still the $20. Now we purchase another 500 of inventory. And then on the 22nd, this looks like the LIFOs. This looks like the FIFOs image. Yeah, this is the same as the, no, it's not.
They're not the same.
They're not, yeah, they're not the same. Just getting really confused right now.
Cost of goods sold January 31st inventory are different.
Yes, you're correct. Yes. And so, okay, it is correct. So the 360 right here is taken from the $22.40 inventory because we purchased 500 of 22.40 inventory on the 10th, and we have to use all that 500 up before we can use up any of the $20 inventory again. And so the 360 comes from the 22.40 inventory, and then the remaining inventory is the $20 inventory at 300 still, and then the $140 inventory. And then this then when we sell another 240, then we use up the remaining 140 of the inventory purchased on the 10th, and then 100 of the $20 inventory. And then our ending inventory, we have 200 left of the $20 inventory, and then 600 was purchased on the 30th. So the most recently purchased inventory appears. But since on the 10th, that 500 in inventory that we purchased was all sold between these two sales, the middle of the month bucket of inventory is no longer there because under the perpetual method, we're recording as we go. That middle inventory is no longer there. So that will not appear on the ending. We'll only have the $200 of the beginning and then the $600 of ending. Does that make sense? I know there's a lot of calculation and but this conceptually is how it works, and I do highly recommend writing it out on paper, your buckets of inventory. That is the easiest way to keep track of it and make sure you're not missing anything when you're doing it, your homework. Yeah, so once again, we have 200 left at the beginning, and then the 600 that we recently purchased. Now, moving average cost is a little simpler and a little bit more math, but it is a little simpler, in my opinion, to calculate. So every time there's an inventory purchase, the unit cost gets recalculated. So at the beginning of the period, the unit cost is $20 because it's $20 inventory. Then the 700 sold, that's for $20 a unit. purchasing $500 of inventory at 2240, now we have 800 units of total inventory, and we assign a cost of $21.50. This is calculated by taking, let's see here, 20 times the 300 that's left, and 2240 times the 500 purchased, and we get the total cost of 17,200, and we divide that by the 800 to get $21.50. That's not the same as taking 2240 plus 20 divided by 2. It's not the average cost, it's the weighted average cost, because the 500 is more units than the 300, so it should have more of an impact on the price than the $20 inventory, right? Because that's less units. So and it's also the only way to accurately compute it, because if we just took the average price, but then we multiplied it over all the units, our total ending inventory balance would not be, it wouldn't tie out. It wouldn't add up to what the actual cost of the inventory was. So then all additional sales use that new average cost that's calculated, so the 2150. And it's just simple multiplication, 360 times 2150, 240 times 2150. And then our additional sale, or our additional purchase at the end, 600 units, we just have, right when we're calculating, we have 200 units at 2150, and we have another 600 at 2330, and then we multiply it out, add it up, and divide, and we get our new unit cost of $22.85. Which of the following inventory methods would have the highest cost of goods sold in a period of rising costs? I think I heard LIFO. That is correct. Because the highest cost inventory purchased most recently is what's included in cost of goods sold. Under the periodic system, remember, no cost of goods sold entries are made throughout the period. And at the end of the period, there's a physical inventory count. And then we calculate what the cost of goods sold should have been to arrive at that ending inventory. And we have our purchases, freight in, purchase discounts, and all that. So in this example, we have a number of purchases and sales, and we're going to compute the first in, first out inventory cost. And the actual cost is going to be the same, but we just have to the actual cost at the end is the same as if we use the perpetual method of inventory. The periodic and perpetual method don't actually impact. I believe that they should not impact. Oh, this is a perpetual example. Okay, well, then we'll just go through this as Yeah. Okay. Well, we'll go through some more perpetual examples and we'll go over the periodic later then. Um, Once again, perpetual inventory method. We're recording as we go and um, assigning the first units that were purchased. For example, the beginning inventory at $29. That's what's included in this in the sale on the 10th. Then the purchase of another 150 and then the sale of 120, we have to split the 30 units remaining from the beginning inventory and then 90 from the recently purchased inventory um, in order to calculate our cost of goods sold for there. And then on the 24th, we sell another 35 units, and that's taken from the $30 inventory purchased on the 15th. And then we purchase 140 units at the end of the period. And so our ending inventory quantity, we have 25 units left of the $30 inventory, and then we have 140 units of the $34 inventory. And the ending inventory is going to be higher under the first in, first out method because the latest inventory that was purchased was at the highest cost. And so if we record that on the balance sheet instead of the income statement, the balance sheet is going to be, right, the ending inventory is going to be higher, cost of goods sold is going to be lower under FIFO. And under LIFO, um, we have to are the only ones that are right. We have the same exact transactions throughout the period, but we have to take from the most recently purchased inventory first. So the sale on the 20th, instead of being split, is going to be fully taken from the most recent purchase on the 15th. So the $120 of inventory is going to be $30 inventory. And then on the 24th, the sale is going to be mostly the $30 inventory as well. We use up the remaining amount. So 120 plus 30 is 150. And right, you can also, assuming you keep the quantities up to date on your piece of scratch paper, you'll know how much is left of each bucket and when it was purchased. So here our ending inventory, we have 30 left. So we use up that 30 of $30 inventory, and then we use up 5 of the original inventory. And then the purchase at the end. So we have 25 of our original inventory and 140 of our ending inventory. Ending on the balance sheet. Now, under the perpetual, so we have the following sales under the perpetual method, and we're trying to compute under LIFO what the ending inventory and cost of goods sold is going to be. And so our initial inventory is 310 units at $88. And then we have a purchase on the 10th of 144 units at $90. Then we have a sale on the 12th of 240 units. And so that 240 units is going to use up all of the inventory purchased on the 10th because that's 144 units. And then it's going to use up 96 of the initial inventory. And so our total cost, our total journal entry for cost of goods sold is going to be the 12,960 plus the 8,448. Then on the 14th, we sell 166 units, and that's all going to come from the $88 inventory because we used up all of the $90 inventory. And then another purchase of 240 at 96, a sale of 200 units. That 200 units is all going to come from the $96 inventory because that was most recently purchased. And, under FIFO, it's going to be always using the initial inventory first. And so the sale of 240 is going to be all from the 310. And then the sale of 166 units is going to be partly from the 310. It's going to use up the remaining 70. And then 96 of the new inventory on the 10th. And then the 20. Under FIFO, though, if you're just computing income statement, if you just are given this is what the transactions are and say compute the income statement, you can compute beginning inventory at what the beginning inventory is, and then the ending inventory is just going to be the final units that were purchased. So if we know our ending inventory is 88 units, and there's less than 88 units in our final purchase, then it's going to be at $96. And so our ending inventory is going to be 8,448. And then you can know beginning inventory, purchases, ending inventory, cost of goods sold is just a plug, right? So under the perpetual, FIFO is similar to it, easier to imply what it should be. LIFO is much more important to go as you go and look at the specific details of what the purchases were, what the dates were, and what the dates of the sales were to actually go in and calculate what the ending inventory, what the costs should be throughout the period. We can go through a few more examples here. So under so the following units are available for sale, and there are 7,700 units on hand at the end of the year, and they give that to us. But if we just added up all the inventory purchases and subtracted all the sales, we'd arrive at that. And under FIFO, it's fairly simple to calculate what the ending inventory should be because we just multiply the 7,700 times the second purchase price, which was $162. But that second purchase is greater than our total ending inventory, so we can just multiply the second purchase, the most recent purchase, times 7,700 and arrive at ending inventory. Under LIFO, we have to actually go through and compute what buckets of inventory are left. So our beginning inventory, we had 9,200 units, then we sold 5,400 of them. And that beginning inventory then was never touched again because we had another purchase of 12,400, and then the 10,400 was all taken from the first purchase because, right, the sale of 10,000 is less than the first purchase. So that all was taken from that tranche of inventory. And then the second purchase is what was used for the second sale. And so to compute our ending inventory, we have to take what buckets were left, and we can compute from there. And then to compute the weighted average cost, every single purchase, we have to recalculate our unit cost. And then we can calculate from the unit cost what our sales should be going forward. So our initial purchase of 9,000 at 50, then we sell 7,000 of it. So we have 2,000 at $50 and 10,000 at 56.50. And so to calculate, and I really do want to go over this, once again in detail. If we take 2,000 times $50, that's 100,000. And then we purchased another 8,000 at 56.50, which is 4,000 to 452,000. Then our total cost is 552,000. And then we have to divide that by the total inventory on hand of 10,000 units. And we get $55.20 per unit. That's our average, that's our weighted average cost. So the second, right, this 8,000 at 56.50 has a greater impact on the cost because it's 8,000 units, and the other, like the existing inventory at the time of that purchase was only 2,000 units. So these both go into our ending inventory balance. And then we have 55, 20. That's our ending inventory balance. That's our new unit cost for the inventory. And we use that going forward for the sales. That's the new price. And then we purchase some more inventory at $60. We have to use the same approach to recalculate our unit cost once again so that we know, and then there's no more sales after that. But then that's our unit cost at the end of the period for our, going forward in the next period. That's going to be what's used for our inventory. So and because this can be so tricky, I just want you guys to have some practice calculating this. So I'm going to give you guys 2 minutes to calculate what the cost of goods sold and ending inventory would be at the end of the month for this, or at the end of the year for this company. So hope you guys got some good practice there. For our first purchase is $4,500, and our to compute the unit cost for that purchase after that purchase, we have 1,500 remaining because we used up, or we had 4,000 minus 2,500 is 1,500, and our unit cost at that time was $50. So we have 75,000 of inventory from the initial purchase, and then we purchased $243,000 of inventory. So our total inventory is 318,000, and then we divide that by the 6,000 in on-hand inventory. So we have 318 divided by 6,000, and we get our unit cost of 53. Then our next sale is at 53, is what's used for our cost of goods sold. And then we purchase another 112,000 in inventory, which is 2,000 units at $56. And then we take our 53,000 plus our 112,000 to get $165,000 divided by our $3,000 in inventory, and we get a $55 unit cost. And then total cost of goods sold for the period is 390,000, and then total cost of the ending inventory is 165. Anyone have any questions on all these methods? It's not conceptually that difficult to understand. Like especially because it's inventory, it's physical goods, it's fairly easy to understand like what goes in, what goes out. It's just the calculation and focusing on the details and the homework that's what's important in this chapter. And so doing the homework, going through the examples, it's the most valuable way to learn. So in this example, we're gonna assume a FIFO method for the same example that we just did. And in this example, it's much easier to compute the cost of goods sold and the ending inventory, especially the ending inventory, because our ending inventory is just the most recently purchased 3,000 units. And so 2,000 of the 56, the most recent purchase, and then another 1,000 of the $54 inventory. And then that comes out to $166,000. And our cost of goods sold is the originally purchased inventory. See, it's all we sold throughout the period. There were two sales of 7,500 total inventory units. And so if you just take 4,000 times 50, and then 7,000 minus 4,000 is 7,500 minus 4,000 is 3,500. So you take 4,000 times 50, 3,500 times 54, and that comes out to 389,000, which was what our cost of goods sold was. But you know, you can go through this entire example, or you can just, if you know it's FIFO, you can say, okay, I know what buckets were in cost of goods sold, I know what buckets are in ending inventory, and you can compute from there. And the quiz this week will have some multiple choice where it can be time saving to use a shortcut like that. So There will be, I think, 3 blank sheets, 5 multiple choice questions on the quiz this week. Um, and then the same example using LIFO. As we go, we have to use our most recently purchased inventory units. And in this case, we're going to use for the 5,000, the sale of for the sale of 2,500, right, we use the initial $50 inventory, and then the sale of 5,000, we use 4,500, all 4,500 of the $54 inventory that we just purchased, and then another 500 of the $50 inventory. And then our ending inventory is 1,000 of the initial, and then 2,000 recently purchased. Okay, now we'll save the periodic for Thursday. That's all I have for you guys today. Thank you, everybody.